Alright, so we did corporate loan. So now we do mortgages. Alright, so mortgages. So mortgage has two fundamentally different meanings. One of the meanings for a mortgage is a loan secured by real estate. In this particular case, mortgage is nothing more than a short for a mortgage loan. So, a loan secured by a mortgage. So now we need to explain mortgage. So, mortgage is an asset or a pledge of an asset which secures a loan so that in case of non-performance, meaning in case of default, the asset will be acquired by the lender in satisfaction of the loan. This is long way of saying is you mortgage your house for a loan, whatever you're buying, laptop, computer, doesn't matter what. If you don't pay back, the bank takes your house and that will satisfy the bank. We call the process repossession, or let's call it first foreclosure.
When the bank take your house.
Yes, so when the bank takes the house. So foreclosure now is, let's define it, is the legal process. So it's a legal process where a lender petitions the court or the judge to transfer a mortgaged property to its name, to transfer the title of a property in satisfaction of a loan. For a satisfaction of a...
Sorry, sir, could you repeat it? I did not understand.
Okay, so foreclosure is a judicial process or judicial procedure where a lender petitions the court to transfer the title or to dispose of the property in satisfaction of a defaulted loan.
You mean to overcome the asset, to take the asset and to satisfy the loan, or case of default?
Let's call it liquidate the asset. Let's call it liquidate the asset. Now, there are two fundamentally different ways and two fundamentally different systems in the world. One is auction. One is auction. The other one is transfer title.
So these are
the two methods through which a foreclosure occurs. In the United States, foreclosure by law must occur through auction only. The bank cannot take the property. It must auction it off and it must bid like everybody else on the auction if it wants to get the property. In many other countries, especially European law, we call it continental law, and I'm certain it works exactly like that in Bulgaria. All the bank does is go to the judge, and the judge simply transfers the title. The judge says, from today, the house is yours. End of story. Well, now the bank is the owner, can actually go, take, we call it the bailiff, the policeman, and throw out whoever is inside, and does whatever he wants to do. He can rent it, he can sell it, he can do whatever he wants to do.
It can be also stocks if he has stocks.
Okay, look, stocks. Look. Guys, let's explain something extremely fundamental for the rest of this course in general. Sun is rising every morning. Yes, it's true. I don't care. This is not the subject. We like to eat 2-3 times. Yeah, it's true. Just telling me something which is true doesn't matter. The question is, how does it relate to mortgages? How does it relate to real estate loans? How does it relate to mortgage loans? What you're telling me is completely irrelevant. I don't care and I want you to waste anyone's time with irrelevant stuff. Is it something that I'm talking about? Ask.
No, but I mean that you can give mortgage of your house. If I have if I have stocks, if I have another project,
Yes.
I can just make it mortgages.
Okay.
Before they sell my house, I'll give it to the banks.
I understand.
That's it.
Apparently you're still missing. I am talking about a mortgage loan secured with a house. That's it.
Just in the house.
For the house, yes.
Yeah.
You have different types of loans. Let's do this. These are called secured loan. Which is a loan secured with something of value. We usually call it an asset.
Financial assets?
Never said financial asset. Something of value. We call it assets. It could be land. That's an example of it.
So
It could
the
be.
term mortgage is only for house.
Term mortgage is used predominantly for real estate and predominantly for houses. It is also occasionally used for land. But you can also secure it with a business.
Of course.
You can also secure it with gold. When you walk into those little lenders, you secure it with your watch.
Yeah.
Alright? In some societies, you could easily pledge your wife. In other societies, it's illegal. In other words, you can secure it with whatever you possess, meaning whatever you have the legal rights to own and transfer. Whatever the law allows to transfer title or ownership of. As long as the law allows it, it's okay. In some countries, they say you cannot pledge this. You know, some of these we call in the United States are called inalienable rights. You have certain rights, and you can't just give up your right. All right, you can't sell yourself. We call this slavery. Slavery is on the Constitution. All right. So secured loans. So loans can be secured with stocks, can be secured with bonds, can be secured with a currency, can be secured with property. When you borrow money to buy a TV, you secure the loan with the TV itself. All right, when you put in some down payment. Could be a car loan. You secure the loan with the car. They may ask you to secure it. So in general, you have all sorts of types. You have dozens of secured loans, usually or mostly for consumer purposes. Now you have other types of loans, but now we're getting into banking called consumer loans. Alright, so this is a loan used to make a consumer purchase. TV, computer, laptop, flat screen TV. Sometimes you may use it for vacation or whatnot. I don't want to get into this because we're trying to cover financial instruments. You see, it's very easy to ask some question and get on the side road of, and spend 2 lectures on loans. That's not what we're trying to do here today. All right, so consumer loans, this is what they are. All right, so back to mortgages.
Consumer loans?
Is a loan which is, used to finance a consumer purchase. To purchase TV, to purchase a camera, to purchase a laptop. Usually it is secured with the asset that you buy.
Yeah.
Usually the TV, alright, will secure that particular loan. Alright, so let's get back to mortgages. Alright, so the first type is so-called conventional mortgage. Back to the topic. Conventional mortgage. It's got different definition, which typically means that the mortgage has a, number one, 15 to 30-year maturity. Second, it is usually fixed, usually given to credit-worthy borrower. Credit-worthy is now known, better known. It's actually also a financial and legal term known as prime. Prime means of high, good quality. The opposite of prime, and I put this meaning unequal sign, is subprime. Prime is associated in finance, and the financial interpretation is low
Risk.
yes, probability of default, which means low risk, and this means higher risk.
You mean the guy himself?
We're talking about loans. So we're talking about default.
How is the low probability of default?
Prime borrower, it has a lower probability of default.
Yeah.
Subprime borrowers have high probability of default. All right? Clear?
Great.
So you need creditworthy. So creditworthy usually is associated with prime borrowers. Let's see. And another key characteristic is annuities.
They use prime and subprime for issuing credit cards, right?
Look, the sun will set tomorrow. Forget about the whole damn thing, alright? Stay focused. Alright? Annuity means equal installments. Equal installments. So, the other characteristic is that the interest rate is fixed and the monthly payments are always the same from the beginning till the very end. And this represents, or these are the characteristics of conventional mortgages. All the other types of mortgages become unconventional. So, in terms of interest rates, the characteristics of interest rates for mortgages are of two fundamental types. There are lots of hybrids in between. The first is fixed, the second is called adjustable. Fixed interest rate mortgage or fixed interest rate simply means that the interest rate remains unchanged and constant for the entire duration of the loan, from the initiation of the loan till its maturity. So if it's 7%, it's 7 until maturity. Adjustable simply means that it is adjusted according to a certain well-defined formula. Usually it's maybe 3% plus LIBOR or 5% plus, let's say, government. So usually it is certain basis plus what we call a markup. So whatever the basis is, LIBOR, government, etc. Usually adjustables are known in the literature as ARMs. It simply stands for adjustable rate mortgage. So when you say an ARM, you mean a mortgage loan with an adjustable interest rate. Alright, is that clear?
Can be adjusted to inflation.
Usually not adjusted to inflation. Interest rate is adjusted to a particular basis, to a particular interest rate, market interest rate. So it's a market determined interest rate like LIBOR, the interbank interest rate. All right, let's see what else we have. So from here, you have so-called MBS, standing for mortgage-backed security. So, a mortgage-backed security is a security or financial instrument which is backed by a pool of mortgages. The best way to think about it is you get one 1,000 mortgages. These 1,000 mortgages you pull together, and they all back that particular security. And let's say that particular security may be worth, let's say, $100 million. And someone will buy this $100 million security, or the alternative is that $100 million security could be sliced into 100 pieces, each worth $1 million. All right? Now, these type of securities are usually known as, and it's a very important term in real estate finance, called pass-through security. A pass-through security simply means that whatever is the income of the mortgage, it is passed through to the investor. So if you bought this mortgage-backed security, the $400 million, whatever is collected from all borrowers, it is immediately passed through to the investor. All right? That's all it is. You just send it to him. So somebody simply does the job for you, and we call this, let's call it mortgage originator.
So this is called pass-through backed securities?
No, pass-through security. Pass-through security. The next concept is mortgage originator. This is the financial institution which generates the mortgage. So this is the financial institution, could be a mortgage company which creates the loan for the first time and works with the customer itself. All right? So usually it gets the money from somewhere, gives it to the borrower, and then gets whatever the mortgage is and sells it back to somebody else. So this is mortgage originator. The next concept is that of a mortgage service company. Mortgage service company could be the originator or could be some other financial institution. This is the institution, financial institution, which has the responsibility to communicate with the customer, to collect the money from the customer, meaning to collect every month the payments from the customer, and to distribute the money to whoever owns the security. In other words, it is not necessary that whoever originated the mortgage, that he will keep the mortgage. Mortgage may be in some investor somewhere in the world. All right? That investor is not going to call the customer and say, hey, pay me the money. There's going to be a local bank which will service the mortgage. So the local bank will be collecting the money, will be sending the statements, will do the accounting and everything else for the customer, and in return the money will be, the bank will be sending the money to the genuine investor. And the bank will do this for yes, we call it service fee. Service fee. Could be a percentage, could be a flat rate, whatever it is. Alright, let's see. Mortgage related, pass through, whatnot. In general, mortgage-backed securities were the original type of securities which later from MBS was the original idea for the proliferation of the so-called ABS. And ABS stands for asset-backed security.
So MBS later on turns into ABS.
No, MBS is the original idea of where you pool loans backed by real estate mortgages and makes one security. Now, this is a more general security which is based on loans backed by something. So you may have asset-backed securities which are backed by car loans. So you get 10,000 car loans. They are backed by the cars themselves. They have some down payments and whatnot. And they will be pulled together and have an asset-backed security backed by car loans. You have asset-backed security backed by credit card loans, meaning credit card receivables.
What kind of assets?
So you have other assets. So what people like to do is they like to have a particular type of asset. It may be consumer loans, so consumer electronics loans, maybe cars, it may be furniture loans. So they will be all backed by all typically other types of assets except for mortgages. If it's mortgages, you call it MBS. It's got a very special market. Alright? So this is ABS security. Alright, let's see what else we have.
Sir,
Go ahead.
can you give me another example? For example, if I want to buy a house, I
Yeah.
can secure it by 10 car loans?
No. Look, we're talking about, no one is talking about you buying your house. We're talking about a security, a financial instrument. A financial instrument is someone's asset. Some investor in Tokyo, Japan has bought this security, and it is someone else's liability. If someone has a liability, let me promise you 10 billion Saudi riyal. And I have the liability, I can easily sign it to you. How good is my liability to you? Well, the answer is, I'm a poor professor who's come to Saudi Arabia to teach for a miserable salary, for a modest salary. My 10 billion promise is worth nothing. Why? Because I can't back it up with real money. I can't back it up with assets. I can't back it up with capital. A promise without real backing means nothing. Alright? The idea is that if I can actually back it up with my house, now it means a little something. If I actually own a factory, it actually means something. Meaning, I don't pay you up 10 billion, you take my factory. You know, I have a car dealership with 50 Maseratis in it, you know. You say, oh, I'm going to take the 50 Maseratis, do whatever you want to do with it. Alright? Now, in other words, if you have a security, it better have some backing, otherwise it's an empty promise. And an empty promise means not a lot in the world of finance, alright? So the idea is that, oh, these are loans and these are promises, but they have these 100 cars, alright? And if things don't work, you can actually go and get the car because they have a legal claim on the car if the security does not perform, meaning the guy doesn't keep paying. Now, what you do with the car, whether you keep it, sell it, that's your problem. It's a whole different story. The same applies for furniture. Is this kind of like clear? It's a basic concept of security. Securing a promise, meaning a loan, with some asset. Alright?
It serves as a collateral. It serves as a collateral.
Yes, which serves as a collateral, which is we call repossessed, or if it's a real estate foreclosed, in case of non-performance. Alright, let's see what else we have. Well, we have a brand new section called
Equities.
equities. Alright, so what do we have about equity? Well, first of all, I think I already clarified this. Equity is a claim of ownership. The financial instrument for equity is called common stock. Because there are lots of other types of stock. It's not, you can't just say stocks. We say common stocks. There's preferred stock, there's callable, convertible, and all sorts of other things. Alright, so equity securities or equity. Alright, so a number of things which I have marked myself is equity provides, usually common stock provides usually voting and voting rights. It provides a partial control of the company. Well, the control isn't big. You can't run the company, but you can vote. If you have enough voting rights, you can actually have a managing director on the board of directors and have some influence into what's going on. So that's the one characteristic. The second characteristic is that of a dividend. A dividend is a payment or compensation to investors for buying and owning the security. Dividend is the economic meaning and rationale for buying the security. I just heard from last week from my students telling me, oh, in Saudi Arabia we don't have to pay dividends. The answer is, well, if you don't have to pay dividends, why would you buy the stock? And the answer is, oh, because the price is going to go up. Well, if the price is going to go up, who is the next even more stupid guy who will buy the stock at a higher price for you if he's not going to get a dividend again? Well, the answer is, oh, because he's going to sell it to an even more stupid guy. Now, we call this is, now you guys are laughing, this is known as a well-known theory in finance. Let's write it out, called the greater fool. Greater fool theory simply says that investors do not invest for the genuine income earned by the underlying assets. Alright, underlying assets in this the stock is actually the machines and equipment, but they invest because they expect to sell it later at a higher price. But why would the other guy buy it at a higher price unless for the dividend?
Maybe he expects that.
Well, to sell, the greater fool theory says that everyone's buying with the sole expectation of selling it to an even greater fool than himself. Well, what's the problem with the greater fool in general buying of assets? Well, the problem is that sooner or later you have exactly 6 billion people in this world and you run out of fools. And when you run out of fools, the whole scheme crashes down. So greater fool theory, usually investments in greater fool theory usually result in one form or another of some sort of a pyramid scheme. I don't want to get into pyramid schemes, alright? Not at least not now. Sometimes they're known, pyramid schemes are known as Ponzi scheme. The key characteristic of a pyramid scheme or a Ponzi scheme is that is that current investors get compensated by the money of the new investors. So let's first have 5 investors, they put in some money, now they're getting 20% return. Well, the asset did not earn anything. So now you get another 10 investors and you use the money of the new investors to pay the old investors, alright? And then you need 20 more investors to pay the original 5 and the original 10, alright? Now I have 5, 10, 20, I have 35 investors. You need 50 new investors to pay the old. In other words, the pyramid, because every time you need ever more investors to feed the old investors. In other words, the returns are not based on genuine income generated by the machine, the equipment, in this case the dividend, but it's generating by coming more investors. This is the definition of the pyramid scheme or Ponzi scheme. Usually once you get into pyramid schemes and whatnot, they usually transform themselves sooner or later into bubbles, but I don't want to get into bubbles because for a pyramid and Ponzi scheme to get into bubbles, you also need two more elements. You need credit, bank credit, to fuel the bubble, all right? So that's a necessary element. I mean, all you gotta think is right nearby is Dubai real estate bubble. Bank credit is absolutely necessary. And the second element is speculation. You need lots of speculators, and these are the two necessary elements of a bubble, of any bubble. Could be bubble in precious metals, could be bubble in agricultural commodities, in railways, in dot-coms, telecoms, in oil, in gold, in real estate, in anything. Well, the key is that in order to keep a pyramid or Ponzi scheme, you need the credit, because the credit's got to fuel the bubble. That's number one. And you need the speculation. Well, what does speculation, what is the essence of a speculation? Speculation means you buy the asset today in the hope of selling it at a higher price tomorrow. Well, the foundation of speculation is the what? Greater fool theory. You speculation means you buy it today to sell it at a higher price tomorrow. Well, you need, so all of these things are intimately related.
Yes or no question? With the Ponzi scheme and are they the same? Or?
Yes, pyramid scheme is the same as Ponzi scheme. They are known by both names. They were known for hundreds of years as pyramid schemes. And over time, with Charles Ponzi, before the Great Depression, in the early 20s in the US, in Florida, was creating these Ponzi schemes. Well, now we call them Ponzi schemes, where he was buying huge pieces of land in Florida. Well, Florida back then was really terrible, was totally undeveloped. He will slice them into smaller pieces and sell them to investors and say, hey, now you got a smaller piece of land, you can slice it all over again, get new buyers, etc. And you're going to be slicing into ever smaller pieces, and you're going to be selling it more and more expensively. So every time, it's kind of like, think of it, the guy bought the whole Florida. Then he cuts it in two pieces and sells it for a lot more. And then everybody cuts it in two and two and two, and you need ever more buyers to feed the scheme. Question?
If the price of the stock increases, does that mean the dividend has to increase also?
Well, if it doesn't increase, then it means something else is going on with the stock. I mean, we can discuss, this is part of what we do is fundamental analysis. In other words, the dividend should typically increase in order to maintain the dividend yield. If not, maybe the price increase has been speculative. Well, usually the price increase will reflect an expectation of rising earnings in the future. And if the earnings materialize, everything is okay. When the word earnings don't materialize, you realize that you made a bad investment. So usually the price is thought in one of two ways, as the infinite discounted present value of all future dividends. So this is called the dividend discount model. The other one is the infinite stream of all earnings. So you discount all earnings. Alright? And the idea is that eventually, if the price rises, it has to assume one of two things. One is speculation based on no fundamentals, or actual appreciation of the stock based on a proper expectations that 2, 5, 10, 20 years down the road, earnings will eventually rise due to sound fundamentals in the company. All right, let's see what else we have. We have board of directors. Directors, these are the guys which shareholders vote for, and they make the big critical decisions. Board of directors will in turn assign the executives. And the executives, usually the CEO, will assign all other executives, sometimes or oftentimes subject to the approval of the board of directors. So executives are the ones who run the company on a day-to-day basis. The board of directors are the ultimates who run, but they don't run it on a daily basis. They don't run it operation. They decide, are we going to issue a smaller or a larger dividend? Are we going to borrow, we need financing. Are we going to borrow with stock or convertible, whatever, or with bonds? So usually the board of directors is concerned with strategic decisions. Are we going to introduce a brand new big product? Well, no, sorry, not product. A brand new line of business or not? So, strategy. You have usually annual...
Hold on a second. Board of CEO is the strategy.
No, board of director does the strategy, and the CEO does the day-to-day operational management.
Right.
So, annual shareholder meeting or meetings. Now, shareholder is synonymous and most of the times identical to stockholder. This is an owner or an investor in a particular stock. So we usually use shareholder and stockholder quite identically. My understanding is shareholder is a little bit preferred in British English, in Great Britain, and stockholder is preferred in the US, but there is no general distinction. So this is the meeting where all major shareholders, stockholders meet, usually once a year, to make important decisions related to the board of directors or some other strategic decisions which the board of directors or executives cannot make, or which the law provides for that only shareholder meetings can decide for it. Sometimes mergers and acquisitions and other type of, when they want to sell out, they say, oh, we can't decide. We've got to have a shareholder meeting for that one, right? So, what else we have? Proxy vote, all right. Compensation, whatnot, all right. Let's discuss the next. This is getting very complicated. I don't want to get into this topic right now. Takeover is when one company wants to acquire another company. To acquire.
To eat another company.
Yeah, in other words, the other company becomes part of the first one. It could be done on a friendly basis where one pharmaceutical company walks to the other and says, hey guys, would you like to make what we call a merger? And they always like to call it a merger of equals or acquisition where the one acquires the other. Now,
sir,
acquisition, go ahead.
Acquisition when my company eats your company, you don't have a choice.
No. You said don't have a choice. That's what I'm explaining now. The first one is called friendly.
I see.
And the second one is called
Hostile.
Now, what is important to understand for you guys, for the exams and for the rest, you have to acquire the proper terminology. When you use words like one company eats another, you get penalty here, penalty there, penalty there. And you want it or don't want it, it doesn't work like that. You gotta say friendly, you gotta say hostile. This is a terminology which has been acquired by everyone in the industry, which everyone uses, which has clear, defined meaning in finance or in law, and one of the major objectives is to know exactly what each of these means, and number two, that you use these particular terms properly, all right? You can't say, I'm going to eat you, but what does it mean? All right?
Of course, I won't write that in an exam.
Okay, all right.
Let's discuss it.
And merger is when you agree to.
Yeah, merger is the two agree that they will become one company.
Sony Ericsson.
Sony Ericsson.
Sony Ericsson, for example.
Sony Ericsson, for example.
When you speak about takeover, do you mean also do you include when government interfere?
Nationalization.
Nationalization or?
In general, takeover means that one company takes over another. It could have hundreds of different forms. I'm just giving you some of the main ones. Yes, nationalization is one other type, where the government takes over the company. Usually the company is in trouble. The government takes over means usually wipes out most of the shareholders, or significantly dilutes the shareholders by, let's say there are 5 million shares now, the company issues 10 more million shares owned by the government. The government takes the shares in order to infuse cash, otherwise the company is in trouble. And now the government owns 70 or 66% of the company and therefore becomes a majority. We call it, in this particular case, there's a separate word called stakeholder. Stakeholder means you have a stake in the company. Stake is the old word in English which uses the modern word interest. Interest. Now, let's clarify the word interest. Interest has a lot of different meanings, alright? So, in this particular case, interest has the meaning of a legal claim against an asset. A legal claim against an asset. Interest has a completely different meaning of a legal claim against a fixed income asset, which is what we usually call, by the interest rate or interest payment, all right? So the fixed income asset will be, let's say, a bond, and a bond pays interest in the form of a coupon, all right? So the coupon payment is the interest payment. So in this particular case, interest is the most general legal term that represents that you have some form of a claim, legal claim on something. Interest has also nothing to do with me having interest, let's say, in geology or in the oil industry as in a scholar, all right? Me having interest in the oil industry means I own shares in an oil company, or I am somehow related to the oil industry financially or legally, not scholarly, just studying, all right? So this is interest. Let's see what else we have. Questions?
Yeah. Now, what's the difference between friendly acquisition and merger?
Okay, yeah, friendly acquisition is when one company acquires another. A acquires B. B does not exist, only A continues to exist. A merger is A and B get together and become a new company. Like rather than Sony acquiring the one, they merge becomes Sony Ericsson. So you get a piece of both.
So, sorry sir, so like Hyundai acquired Dell, right?
I don't know the story, for example, yes.
That's a friendly acquisition.
Well, the question is, do they kind of like change legally? Legally, there is a little difference. There is some difference. I don't want to get into the legality. The idea is, do you want it to happen or not? If you don't want it to happen, it's hostile. If you want it to happen, it's a matter of legality whether the second will stop to exist, whether only the first will exist, or whether a new entity will be created that will merge the two. We're not too much concerned with the legality of the whole thing, because it gets into a completely different subject, the mergers and acquisitions. Just like in real estate, when you study real estate, you're going to have at least 1 week, 2, 3 lectures on studying the legal issues of real estate with everything. The same is with mergers and acquisitions. Right now I'm trying to get completely different stories. Alright, so I covered a long time ago, one of the very first lectures, the concept of residual claim. Residual claim. So, residual claim claim represents a claim or an interest on a residual basis. Residual means that you get whatever is left over from assets or income after everyone else's claim has been fully and properly satisfied. In this case, as I was explaining last time, when you asked, it means lowest priority. So the highest priority claim always has the judge and the courts. The second one will be the legal system. The third one will be the tax system. And only then, once you satisfy the judge, the government, and everybody else, only then you get the secured interest. Secured with a particular asset, real estate, or whatever that might be. Then you get employees and salaries. And then you get the unsecured assets, unsecured obligation. And then once you satisfy every single claim that you can satisfy, whatever is left over, we call residual. And this is what in the entitlement of the equity holder. The equity holder is entitled or has a residual claim. In this sense, he bears all the risks for losses, but also bears all the benefits of profits. All right, let's see what else we have.
Don't you want to stop here?
Hmm?
Don't you want to stop here?
Well, let's go for another 15 minutes, all right?
No, sure.
Huh? You have time?
Right.
All right, so after residual claim comes the concept of liquidation. So, liquidation is the process of selling the assets of a company and converting it into liquid assets. In other words, to convert illiquid assets into cash.
She gets that.
Into cash. So liquidation is the process of selling out assets. Could be stocks, could be bonds, could be real estate, could be watches, whatever it is, and converting it into cash, usually for the purpose of satisfying some claims or some obligations. Sometimes or oftentimes liquidation is associated with a bankruptcy.
So I'm not able to follow the book.
What? They don't follow the book, follow the lecture.
Okay, well, what page is it?
My page is 40, characteristics of common stock. So 2-3 equity securities. The first section was common stock equity. Now I'm doing characteristics of common stock. So one of the characteristics of common stock is liquidation. Upon liquidation, to satisfy whatever it is, and the rest, residual claim, is what you have. Now, liquidation usually occurs during a bankruptcy or bankruptcy proceedings. So, bankruptcy is a legal procedure where a company is in default and unable to satisfy its obligations on time and in full, and the claimant, meaning whoever is owed the money, initiates a legal procedure to collect his claim. In other words, I lent the company $5 million, the company doesn't have the money to pay me, in other words, it's defaulted on me. I can't go to the company and ask. I can say, please give me the money back. When the company says you can't, you go to the court and file a bankruptcy. This means that you force the company into bankruptcy. So the judge will review, and if he believes that you have a proper, valid legal claim, the judge will declare the company bankrupt. Upon that, he will assign a person who will supervise the so-called bankruptcy proceedings, and he will order the liquidation of the company meaning the selling of its assets, and satisfying the obligations according to the order. If there's money left for the claimant, he will get his money. If after selling all assets there is money left for shareholders, they will get any money. If there's not left, they won't get any. Alright, so let's see what else we have here in terms of concept. The next concept is that of, let me return back to the dividend. So the dividend is the income from a stock, from owning a stock. You have different types of incomes, dividends. The most important one is a cash dividend. This is where you get cash for your dividend. This is the best type of dividend. Of course, good, bad has other criteria. Got to think of tax implications. The second one is known as a stock dividend. This is a dividend paid in stock. When a company pays dividend in stock, you as an investor is a big red flag telling you that probably something is dead wrong with the company.
Sure.
It's a big alert. Why is the company not paying in cash?
They don't have.
They don't have it. Probably they don't have it. Well, if they don't have it, you gotta ask the question, what's wrong with the company? Why is the company not generating enough cash? What's going on? Well, sometimes the company will have a legitimate reason. It may decide to invest. For example, Saudi Arabia just spent $10 million on its Kuwait field. Well, if you're going to be spending $10 million, say, hey, we got the asset. We need $10 million capital. They may want to conserve the cash for a genuine investment. But the problem is, are they conserving cash which they have and earn and generate, which is good, or they're not earning the cash and they're making a phony type of dividend where they just say, oh yeah, we're giving a dividend in the form of stock. Alright? This type of a dividend where it's stock because it actually did not have cash is really, really bad signal. It's a really bad signal. Alright, so you have to be very careful when the company declares dividend at the time. And the third one is very interesting, usually extremely rare, is in kind. It gives you some other assets beside cash or the stock itself. It may just give you pens if it's producing pens. If it's producing stoves, it gives you stoves. If it's producing lamps, it's giving you lamps. If it's a real estate company, it may just give you a little piece of land. I mean, it's some other type. This is extremely, extremely rare. Sometimes it may be agricultural companies producing weeds. Rather than watering, selling the whole wheat, they just say, 1 ton for each person. So each 1 ton wheat. You go and come and pick it up. Show me your shares. You got 50 shares. Get yourself 50 tons of wheat. Move on. All right. Extremely rare. Let's move on. Now, when the company generates profits, in finance, we actually a lot call it earnings. We use very important terms here. You can do 2 things with earnings. The first is, and this is the term which you have to use, is called you pay out. Pay out, usually, dividend. In other words, when a company makes money, it can make one of 2 things. One is, we call it also distribute. Distribute. To shareholders. And the other one we call reinvest. Not invest. Reinvest. Alright? Reinvest is associated that it puts it back into the company. Sometimes it's called plow back. So for this, you have the term plow back.
Is it the same as cash flow?
Not really. Cash flow is a little bit. So earnings is the same as profit, but you should know the difference between a profit and cash flow from your finance introductory corporate finance course. You should know the difference. Cash flow is actually what you made in cash. Cash in, cash out. I don't want to get into cash flow right now. So you make some money. You can either put it back in the company, which we call reinvest or pile back, or you can distribute it as a reward to investors. You pay it out in the form of dividends or distribute it in the form of, it's one or the other. So if you earn, let's say, $100, you pay out 30%, you call that the payout ratio is 30%. The other one is called plowback ratio is 30, respectively 70%. The payout and the payout ratio, the plowback ratio, always sum up to 1. All right. So stocks have a dividend yield. And this is simply defined as the dividend divided by the price of the stock. So the price of the stock is 100. The dividend is 15. So the dividend yield is 15%. Usually it is reported in percentage. In other words, the dividend yield normalizes the absolute value of the dividend relative to price in annual percentage terms. Usually dividend yield of 3 to 5% is normal. Below 3% you consider it relatively low. Below 5% you consider it high. It has implications for fundamental analysis and valuation.
The result is percentage or multiplied by percentage?
No, we convert it to percentage. So you have, let's say, $7.5 is the dividend, 100 is the price, so it is equal to 0.075, which now we convert to 7.5%. So usually it's reported in percentage. So when they say dividend yield is 3.3, you understand that it's 3.3%, which is the ratio. All right, let's see. Then we have dividend yield. Then we have earnings. Earnings.
Another term?
Yes, earnings yield equals the profit, which is the same as the earnings. The profit, the same as earnings, divided by price. So let me, I can do this, wipe off this example. So it is profit divided by price, and again.
So profit per share or?
Yes, profit per share. We call this, yes, we call this earnings per share. Yes. Earnings per share. Correct. Share. Alright, so when I say profit is the same as earnings. Alright? So we say earnings per share divided by the price of the share, usually in percentage terms. Now, again, we annualize it. We take the annual earnings per share. Of course, now we have forward, backward. You should have studied some of this already before. Let's see what else.
What is normal? Dividend yield between 3 and 5 is normal.
Yes, earnings yield should equal to, and now I'm jumping many lectures ahead, to the required rate of return. So it should give you a compensation for the risk-free rate, compensation for inflation, we call it the purchasing power, and a compensation for risk. So usually Wall Street would like to sell you stock with earnings yield of 5%. This means an extremely low earnings yield. Means you get a very low risk premium, you get a very low compensation for inflation. It's not worth it. In other words, earnings yield 20%, so 5% equals, and let's define this now, price earnings ratio equals to price divided by earnings per share. Now, usually when I say profit here, earnings per share is usually preferred to be written by almost everybody as EPS. So this is a standard abbreviation that we all use in finance that you should be able to use comfortably and without problems. So the earnings yield is the inverse of the price earnings ratio. So if the earnings yield is, let's say, earnings yield and price earnings ratio. If the earnings yield is 5%, the price earnings ratio is 1/5%, which is 20. If the earnings yield is 10%, the price earnings ratio is 10. If the earnings yield is 20%, the price earnings ratio is 5. What you want as an investor is a very high earnings yield, which mathematically is equivalent to a very low price earnings ratio. Let's see what else we have so I can finish for today. Alright, what you also have is, I should be done in less than 5 minutes. What you also have is, all I was discussing so far is common stock.
Sir, would you repeat the example of the inverse?
It's very simple. The earnings yield is 5%. This means that the one divided over the other is 5%. 1/20. This means that the second divided over the first is 20. Alright, let's try to do this. Example for dummies. Dividend equal, earnings. Earnings. EPS equal 5. Price equal 100. This means that the earnings per share, this means that
5 or 5%.
earnings yield equals 5%, and the price earning ratio equals 20. So earnings are 5, price is 100. When I divide 5 by 100, you get 20. The price earnings ratio, price is 100, the earnings are 5, you divide price by earnings, gives you 20. The way to think about price earnings ratio is how many times you pay for the earnings. If the earnings remain constant, and don't grow, the price earnings ratio gives you the payback period. So, if earnings remain constant and don't grow, and the price earnings ratio is 20, the payback period is 20 years. Certainly that's a bad investment. You gotta wait for your money back 20 years before you make real money. Now, a price earnings ratio of 5% of 5 means that your payback period is 5. This assumes no growth of dividend. Question? No question.
So the lower is the best. The lower.
Yes, the lower is the best. This is equivalent of getting a higher yield. Alright, let's see. I have a few more things. Number one is preferred. Preferred stock. So, preferred stock is the other type of stock besides common stock. Preferred stock provides some sort of a guarantee, kind of like a guaranteed dividend yield.
Fixed.
It's a hybrid between bond and...
Yes, it is a hybrid between a bond and a stock. Usually it provides some of the benefits of a stock, but it also provides a relatively fixed yield like that of a bond. Well, but the fixed yield is only if the company has the money and the cash to pay. If the company does not have the cash, it doesn't have to pay the dividend. That's the difference between a bond and a preferred stock. So a preferred stock usually cannot force the company into bankruptcy because you're a stock owner. So here, usually if you don't pay the dividend, usually the dividend is cumulative. Cumulative means if you don't pay it this quarter or this half year, you are still entitled to get it next time. And next time you're entitled to get it twice. If it skips 5 times, you add all 5 times and it must be paid before the common stock owner can get any type of dividend. Question?
Only if the company announced a dividend, right? Only if the company announced a dividend.
All what?
Only if the company announced a dividend, right?
Yes, so for the preferred stock, look, the company board of director may announce dividends, it may not announce dividends. If it has cash, usually it will. If it already have a certain dividend yield or certain dividend, if the company, we call it to cut the dividend, usually it is a disastrous for the stock. Just like GE has been giving and growing dividends for the last 70 years, ever since 1938, the Great Depression. For the last 70 years, it has never cut the dividend, it's always growing. Well, now they just cut the dividend, and this totally and completely devastated the stock. Literally, in a few minutes, the stock, 70-80% got wiped out. So, usually, you don't want to cut the dividend unless you're totally desperate and have to, all right? So, in that particular case, when they cut the dividend, it's a terrible market signal. Something's wrong with the company. The company can't generate cash. The company expects to run losses. Something else is going on. So, usually, with a preferred stock, will provide the dividend anyway. Once the company cannot provide the dividend, this means that, it's not generating the cash. There are some fundamental problems. So, if you got a preferred, you'd better keep paying. If not, it's a bad signal. And if it's a bad signal and your stock falls 5 or 10 times, now you're in deeper trouble. You can't issue stock because the price is too low. You can't raise much money. But now the stock is fallen and your liabilities remain fixed. The equity has shrunk. Your leverage has increased. Lenders won't lend you. You get in trouble, financial trouble, real fast. All right, let's see more questions because we're trying to finish for today. More questions? No, let's try last question.
Sir, the preferred stock, the dividend, preferred stock, does it become liability for the company?
Okay, the dividend for the preferred stock becomes a liability for the company only if the board of directors declares the dividend. Becomes a legal liability. If not, it is not a liability. The company does not have to pay today, but it's usually cumulative. So you owe me, let's say, whatever the percentage is, 5% dividend, $5 per share. Next time you gotta pay 10. And you can't pay anybody else unless you pay the full, everything that has been accumulated. So you may not be paying for 2, 3, 4 years, but the dividend keeps accumulating, all right?
Plus interest?
Well, the interest is a little tricky. I don't want to discuss interest on undeclared dividends which have been accumulated usually without interest, but the market will begin to discount that one too. The market. So legally, you don't have to add interest on top of the dividend. but the market discounting mechanism will factor in the expectation of interest on top of the unpaid dividend because it's not a cash flow. So when a cash flow is postponed in time, you got to factor in interest. Well, the discounting mechanism of pricing stocks, including preferred stocks, will factor in this. And then you may have, the other type is convertible. Convertible preferred stock means that you got a preferred dividend, you got a dividend, but at any point in time, you may decide for a fixed predefined conversion ratio to convert preferred stock into common stock. Alright? And this ends the section, and at least I'll end the whole chapter. Next time we begin with portfolio theory. So I'm done with chapter, in my textbook is chapter 2, and we continue with the 4 chapters on portfolio theory, whatever they begin. That's all.